every foretelling that Michael Burry made is spinning into reality, just like the author R.L. Stine's storybook Demon starting to come to life in the movie Goosebumps. In early 2021, Michael Burry indicated that we would face massive inflation for years to come and alerted investors about the upcoming stock market crash, but no one gave attention to him. But to everyone's shock, all of his predictions came to be true. The United States is facing phenomenal inflation, and the stock market is making new lows every month. The Nasdaq is down 32%, and the S&P 500 is down 23% year to date, and yet there's no stop in view. He used a dead cat bounce prediction to warn investors to avoid getting trapped into buying the bear trap rally, and since that date, the market's down almost 15%. The most startling and interesting prediction of Michael Burry, which persuaded me to make this video, is bothering. Michael Burry tweeted, "We're not even close to the bottom. This means investors are not paying due concentration to the seriousness of the crisis, as the worst is yet to come, and to ensure that the financial tsunami does come, the public must understand and prepare accordingly." So in this video, we'll examine why Burry is so questioning and what are the keys he's proposing to keep up with the upcoming crash. According to Michael Burry, 3 major factors will cause a destruction worse than the American economic recession back in 2008. Assessing these 3 factors, Michael Burry has sold nearly all of his stocks. You'll be amazed to know what he said. In his tweet, he said that inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell. It'll be because of the essence or nature of inflation. It resolves, fools people, and then goes back. When it comes back, neither the POTUS or the Fed will take credit. The attached diagram shows the inflation cycles that arose in the 1940s and 70s. The foremost inflation spike was followed by the larger second one, which can be indeed seen. This is because the economy usually falls down after the first inflation spike. This forces the state to print money to protect the economy. However, states don't know that inflation returns more terrifyingly. The praise goes to the concept of the velocity of money. We can estimate its value by dividing GDP by the money supply. For example, an economy transacted pizza only. 3,000 pizzas were dealt in this hypothetical economy in 1 year. The cost of each pizza is $10, so we can figure the GDP by multiplying 3,000 by $10. So let's say $10,000 is the total money supply. Discover the velocity of money by dividing $30,000 by $10,000, so the answer is 3. This indicates that the average US dollar was utilized in 3 transactions around the year. This is the velocity of money. Throughout the past few years, the money pool has boosted radically, yet the velocity of money has stopped working. Michael Burry stated in his tweet that velocity is nominal GDP over the money supply. QT plus higher rates started to push M2 down, yet we're seeing a tick up in velocity emerging from narrative obscurity. In 1978 and 79, rising velocity trumped falling money supply to drive inflation higher and higher. The redux would shock. The given chart is depicting the velocity of money and money supply. The white line here demonstrates the velocity of money running from 2.1 to 1.1 in 1990. It shows that in the past, the average dollar has been transacted 1.1 times a year versus 2.2. It can be noticed how well the velocity of money is growing again. If the velocity of money goes on accelerating, this means inflation will be more intense. In another graph, Burry showed the nature of inflation, which is cynical. In the 1980s, inflation returned roaring at 15% plus annually. Another tweet from Burry says that inflation has always been peaky and never just one peak, so it resolves a brief deflation in the 40s and 50s or disinflation in the 70s and then comes back. An inflationary cycle generally spans years, and inflationary eras have spanned decades. The attached chart shows CPIS over the years and annual development of US GDP. The correlation between these two can be seen. CPI goes up, denoting that GDP rises as well, which suggests with the crash in costs in the coming months, the economy will tumble too. With an altogether economy going down, certain percentages of people will suffer more than others. Mr. Burry wrote that when something falls from the sky, it's not the fault of whoever put it up there in the first place, unless the Fed put it there. Keeping in mind the coming matters, the Fed is discouraging expenditure. However, the fiscal government is still consuming money. The Biden administration is sending out the spending bills that will be adding to the inflationary wave. Burry explained the phenomenon in a tweet where he said that with recent spending bills, including the student loan forgiveness now approaching $2 trillion this year, we have the emergence of the fiscal pot not just for COVID anymore. It'll be as good for America's economy as sugar for babies. Murray has very well clarified the existing economic situation with the help of the analogy of sugar. When one gives sugar to a baby, it feels good, but over time, it may come to be regular of taking more and more sugar, which ultimately causes harmful effects on their health. The way the fiscal government is behaving is the same. They boosted the economy by consuming trillions of dollars in the short term. However, in the long term, it'll crash. The economy will hope for more money and it will direct to a second, more brutal wave of inflation. Though a powerful possibility of a second wave of inflation is there, there's another more sober issue. The White House re-explained what a recession is in July of 2022. One of the justifications for this activity was that the unemployment rate was at 3%, which is an all-time low. In 2020, the unemployment rate was 15%, and therefore 3% is still bullish for the economy. It's inferred that people aren't being laid off and the economy is powerful. However, this hypothesis is false. The unemployment rate is a covering element, which means that this number is only the lagging factor behind the recession. And if unemployment is low at the moment, it will increase shortly. Quoting here Michael Burry's tweet, which says that the white-collar employment bubble is bursting right before our eyes, and the longer it takes the redundancy to disappear, the more permanent the decline in employment will be. Work from home will in time be seen as a culprit. The upcoming crash of employment will affect the entire economy. Though this is a humongous issue, there's yet another one more serious than this issue, and it's margin. It's when the investors take loans to purchase the investments. Theoretically, taking margins isn't bad, however, it's pretty darn dangerous. For example, if you instill $50 in a brokerage account and get another additional $50 in the form of a margin loan, if the portfolio goes up 60%, then your investments will be worth $110. On the opposite, if they go down by 60%, your investments will have a worth of negative $10. Yes, this is the case. Margin calls will not let your portfolio go unfavorable in actuality. It's when the equity drops below the necessary percentage of the portfolio, margin calls force one to deposit some spare money in the account, and if you won't give in, then the vendor will sell your positions without initial notification and will charge an additional fee as well. Margin works great while on the upper side and serves worse on the bearish side. Currently, we're on the brink of the largest bubble of margin in our record. Due to alternative investments such as futures and options, margin calls happen easily because of enhanced volatility. When an investor gets the margin calls, as the broker will be dealing assets, therefore, asset prices will be lowered. This condition will allow others to earn margin calls on lowered prices and even more margin calls. Credit card debts further flare the method over the last 5 years, rising to $4.6 million. The rationale behind this huge rise is the ease of access to credit cards. Goldman keeps stepping into it. AIG was rescued to save Goldman from the other subprime issue that everyone swore wouldn't be contagious. Goldman's Apple Card? More than a quarter to subprime borrowers. 3% loss rate on that business as of Q2, Burry said. The recession is a regressive tax, implying that the lower class will hurt harder, as examined earlier. Goldman was given more credit cards to the lower classes. The rise in inflation, the lower class will be suffering harder. Margin bubbles and credit card bubbles will cause a collapse in the economy. Margin leverage isn't what it seems because options. VIX isn't what it seems because futures. Consumer credit isn't what it seems because inflation. QT is exactly what it seems. Mr. Burry means to say that volatility, margin influence, and customer credit are worse than they seem to be. On the contrary, when the Fed pulls out the money, crises will be horrifying. Today, I wondered if this would be worse than 2008. What interest rates are doing, exchange rates globally, and central banks seem reactionary and in CEO mode. One of my analysts said it was spooky that today I would wonder that Alpine, Mr. Burry wrote. Though Michael Burry is denounced for predicting the crashes only, this trace history has been great. No, we haven't hit bottom yet. Wait for failures, then look for the bottom. 2 SPAC EFTs failing is not near enough.